Hello and welcome to today's Advanced Financial Reporting and Analysis Revision. And in today's lesson, I'll be discussing the impairment of assets under IAS 36. So, impairment of an asset simply means that that particular asset has suffered a loss in its value, And to compute whether an asset has suffered loss or has been impaired, we simply compare the carrying amount of that asset with its recoverable amount. And to conclude whether an asset has suffered loss, the carrying amount has to be more than the recoverable amount. Let me give an example. If you are given the carrying amount of an asset to be 2 million and the recoverable amount to be 1.5 million, then we can conclude that that asset has suffered an impairment loss of 500,000 shillings. So to write off this impairment, we simply credit the asset account and debit the profit and loss account with the impairment. We simply credit the asset account to reduce the value of the asset and debit the P&L account with the impairment. Now, what if an asset has been revalued and that particular asset that has been revalued has also been impaired? What happens then? So the first thing we do is to write off that revaluation reserve of that particular asset. And how do we go about that? We credit the asset account to remove the revaluation, to write off the revaluation, and debit the revaluation reserve. So let me give an example. Let's say we have an asset. Say motor vehicle. This motor vehicle has a carrying amount of, say, 200 million. This motor vehicle has a carrying amount of 200 million and a recoverable amount of, say, 180 million. And this particular motor vehicle has been revalued to 250 million. This motor vehicle has been revalued to 250 million. So in such a case, we first of all write off the revaluation. Let me create the account of motor vehicle. Let me create the motor vehicle account. So from our example, we have seen that the motor vehicle has a carrying amount of 200 million. So we go ahead and write that balance. So it has a balance brought down of 200 million. It has a balance brought down of 200 million. This motor vehicle has been revalued to 250, which means the revaluation amount is 50. So we go ahead and add the revaluation here. Revaluation of 50 million. A revaluation of 50 million. So the first thing we do is to write off the revaluation from our motor vehicle account. We simply credit the motor vehicle account with the revaluation of 50 million, and then write off the impairment. Again, write off the impairment. So comparing the two amounts, the recoverable and the carrying amount, the recoverable amount and the carrying amount, we can say that the vehicle has an impairment loss of 20 million. So I can go ahead and credit the 20 million from the motor vehicle account. So I can say P&L 20 million. 20 million. If I were to create the revaluation account, it will be the revaluation reserve account. Go ahead and debit. Go ahead and debit the revaluation reserve account for the double entry motor vehicle with 50 million, not 20, sorry, with 50 million. So that's it. The main point you're supposed to get here is that in case an asset has been revalued, we need to write off that revaluation and go ahead and now compare the carrying amount with the recoverable amount so that we can determine whether that particular asset has suffered impairment loss. Now, we have said that impairment loss, when checking whether an asset has been impaired, we compare the carrying amount with the recoverable amount. We compare the carrying amount with the recoverable amount. Now, I want us to discuss what recoverable amount is. What is this recoverable amount? And to determine the recoverable amount, we compare two figures. We compare the fair value, or simply the net realizable value, and the value in use. And take the one that is higher. What do we mean by net realizable value? Net realizable value is the fair value of that particular asset less the cost to sell. Fair value less cost to sell. The net realizable value is the fair value less cost to sell. Now, in case we are told to calculate the net realizable value, we simply take the selling price of an asset minus the cost to sell. Minus the cost to sell. Now we have said that the recoverable amount, to sum up that, the recoverable amount, we compare two figures. We compare the fair value of an asset, or the net realizable value, and the value in use. So to get the recoverable amount, we simply compare the value in use and the net realizable value. And we know that the net realizable value, we take the selling price of that asset less the cost to sell. Now, what about the value in use? So for the value in use, to get the value in use, we simply ask ourselves, what are we projecting as our future expected cash flows that will be generated from the continuous use of that asset? So once we have calculated, we get the present value of those cash flows. And for the cash flows, we have three components. We have cash flows generated. So components are simply for the value in use. For the value in use, we can say that we get the present value of future cash flows. Present value of future cash flows generated from the continuous use of the asset, Now, there are three components. Of cash flows that should be discounted. There are three components. So let's look at the components of cash flows to be discounted. The first one, we can say these are the cash inflows generated from the continuous use of the asset. Cash inflows generated from the continuous use of the asset. Number two, can say any cash outflow that will be incurred in order to generate cash inflows. Any cash outflow that will be incurred in order to generate future cash flows. And lastly, any cash received or paid. Any cash received or paid. So on our next lesson, we will look at a simple example so that you can get to calculate the value in use as well as the net realizable value. See you in the next class. Thank you.